send it off. Hopefully, let me know if you get that. And,
Will do.
and you can jump right in.
Okay, thank you so much.
Okay, all right.
All right, bye.
All right. Am I in?
Are you there, Mark?
Hello, can you hear me?
I hear you. I don't see you. There you are.
There I go, yeah. Just, yeah, I had a majorly cut and paste on that question. I just couldn't find the right words to make it too big and just try to dumb it down. And I'm not going to do it before and after. It just didn't flow. So anyway, we'll just ask those two in the front.
All right. Who is jumping on early? There's a Raymond Plummer here.
Just in the midst of all this, I forgot to email out the link to the county executive and Anirban. So they just both called, so they'll be dialing in, hopefully. Just make sure I've got that in there. Can you send the link for the webinar? That's just Zap, so she'll call me back if that's not happening. Yeah, I mean, I think we're pretty much set. So crashed into what some are calling an infodemic. There's just so much information out there. It's just hard to understand which, and it changes so quickly. One of the areas of great concern that we all need to understand is where are we economically? You know, we do read about the state of business and the unemployment numbers, but as we move forward, you know, what's it going to look like? So the focus today is to present some information to everyone who's participating about current economic conditions and how things may look when we get to what I think we're all collectively calling the new normal, and what's that going to be like. So we're very pleased to have with us today Anirban Basu, who we'll be hearing from in a little bit. But one of the things we wanted to do is set the stage a little bit to kind of take everyone's temperature who's participating. So we've got a couple of poll questions. I'm going to see if we can get put up and see if folks could answer them as we get started. So there's our two questions. So let's take a minute or two, if you all could just take a look at those and fill them out. And then we're going to come back and take a look at the results right before Anirban makes his presentation. So first, we want to kind of get a gauge of, you know, when do you expect to return to pre-COVID-19 level of activity? So that's question one. And question two kind of focuses in on that new normal. When the stay-at-home restrictions have been lifted and a vaccine has been developed, at what level do you think your organization or business will return as compared to pre-COVID-19 activities? So let's take a couple minutes, and if you all can go ahead and fill those out. And as we're doing that, I do want to recognize our sponsors that made this possible today. Live Casino Hotel and the Anne Arundel County Community College. We're very happy to partner with them to push this out there because I think it's important information to do that. We're also pleased to have BG&E as an ongoing sponsor of our Moving Forward program here. And today we've had some other chambers are joining us today to support or get the vital information I think that we're all looking for to understand, you know, what our next steps are. So thanks to the Southern Anne Arundel County Chamber of Commerce, the Central Maryland Chamber, the Greater Severna Park Chamber, the Crofton Chamber of Commerce, and the Northern Anne Arundel County Chamber of Commerce, who are all on the line today. So it looks like we've got about 205 folks plugged in to this today to get us started. And I think what we're going to do is going to try and respect everyone's time and move forward here. I would like to take a moment and introduce the Anne Arundel County County Executive, Stuart Pittman. The County Executive has been working 24/7, literally dealing with all the operations of the government and a lot of the essential services that it provides, from EMT to public health to the police, and then understanding how to keep the rest of the government running and keeping all of us safe as best we can. So we're very pleased to have the county executive with us today. And so I was going to ask him to give us a little overview of what's going on. And how are you doing, Mr. County Executive?
I'm doing okay, Mark. Thank you. Yeah, and thank you for putting this together. I had a meeting with 6 of the chambers, the local chambers, as well as the Anne Arundel and Annapolis Chamber just a few days ago. And they were explaining to me how critical their work is right during this time. I guess it's the dues are the last bill paid, and the call is the first one made to get some help from your local chamber. So please support your local chamber, and we're looking as county government at ways that we can do that as well. I'm looking forward to sticking around and hearing what Anirban has to say as well about the big picture of the economy. But I just want to say a few things about what we're confronting and what we see. The budget projections dropped $63 million in a period of about 3 weeks from when we started putting our budget together until we really got into the meat of it. And that was an interesting process, figuring out how to drop $63 million out of a budget. It was a budget that we were hoping for. So what we sent to the council, and the council is working on right now, they got till mid-June to make their amendments and approve it, is a budget that pretty much defers the progress that we had hoped to make. We did do for the school system what state law requires, maintenance of effort. We were able to get a little bit of a step increase for the teachers. It comes out to between 2% and 3%. We weren't going to do anything for our non-represented, but we ended up at the last minute giving them a one-time $1,500 to soften the blow that they were getting nothing. And then the labor contracts we had actually had been negotiated in advance. So by law, that's what we've got, and the council will have to decide how to deal with that. But it's, I think it's a responsible budget. What we didn't want to do was to take this year and just expect the absolute worst. We'll know better as we get into the year. We're not dipping into our rainy day fund. We may have to during the year if things are worse than projected. But so that was a good exercise, I think, for all of us to have to look at what the next year is going to look like with lower revenues. I think we're lucky in this county in some ways. Our numbers we're 10% of the population of the state, and we're about 7%, 7.5% of the positive cases in the state. A little less than that in terms of the percentage of deaths. We have 117 so far. Folks who unfortunately we don't recognize because we don't know who they are, but I always try to remind people that there are families, there are people who have actually died alone as a result of the isolation that they're under during this time. So our hospitals are a tough place to work, and we're actually going to start publishing data either tomorrow or the next day on the hospital census, and that's a number that the governor is looking at as one of his 4 metrics to make decisions about what phase of reopening to move into. And I just got off a call today with the governor and with the county leaders, and it looks like what's coming next tomorrow, in fact, is going to be the beginning of phase 1. There were some minor steps taken that I supported in terms of getting on the water and getting out on the golf course and a few things like that I don't think are going to have a negative impact. But the governor is going to say what people can do in the best case scenario, recognizing that some of the bigger counties in central Maryland are going to move a little slower than what he's going to allow. So there's going to be a lot of latitude there, and we're just going to take it one step at a time as that information comes in. One of the metrics that the governor looks at, and that we should all be looking at, is contact tracing. So we know there's not enough testing. We are all hustling to try to acquire testing capacity. The 500,000 tests from South Korea, they're still waiting on swabs, so those are not being deployed yet. But Montgomery County is, we think, a half a step ahead, maybe a few days ahead, in announcing something that will increase testing capacity. But our health department and our purchasing people are scouring the globe as well, working to get swabs and working to get full test kits so that we can make testing available more widely. I know that to open up a business, the more testing you can do of employees, the better. and the more comfortable customers feel when they come in. But our contact tracing program, we're the only county in the state, one of the only ones in the country that have managed to do contact tracing on every single positive case, and not only call that person and talk to them about who they've been in contact with, but plan their isolation and call everybody they've been in contact with and help them plan theirs. And so in some cases, that's very difficult. We're having to provide food and hotel rooms for people who can't isolate. And hopefully that's going to pay off in the coming weeks in our numbers. We've found nobody in the business world will be surprised that there's a lot of red tape in government, and not only in trying to get things done from the outside, but on the inside as well. And trying to move at the speed that you need to move to meet people's needs and move the gears of government to get things done quickly in a pandemic is a challenge. So the emergency declaration helped a little bit with some of that, but we have some charter amendments that we're looking at to help with that. And I think I think we're improving local government as a result of the pressure and the need to move fast. So I've got a collaboration started with the school district, for instance, on family assistance, so that our staffs work together because we're serving the same families and try to improve our performance. And we're looking at performance metrics everywhere and trying to get the bureaucracy out of the way. I've been on the phone every week with the staff, full staff meetings of economic development. And that's been a wonderful thing because I was not in as close contact with those folks in the past, and this crisis has made it essential to be so. And they're a hell of a team there. They, first were working on trying to help as much as they could, getting people first access to the Commerce Department state loans and grants, and then the PPP program and all of the challenges with that. But we, at the same time, we're talking about what county government could do. And with some federal money coming in, we talk to other counties. I'm actually on the phone with the Big 8 county executives 3 days a week where we compare notes. And I asked them about the small business assistance programs that they've done and how they feel about them. The challenge for all of us is that the need is so large and the money is a drop in the bucket. Even the state found that when they had to close applications on the Commerce Department program. So, and there's no way that we can't print money like the federal government or borrow that kind of money. So what they've come up with, I probably shouldn't tell you because we're not announcing it till Thursday, but I'm not very good at keeping secrets. So I'm going to tell you what we're going to announce on Thursday for small businesses. And we're going to call it the Small Business Customer and Employee Protection Program. At least that's what we're calling it right now. There's still debate over the name. But that's the concept, is that we will give small grants to businesses with 50 employees or less that are based in the county to protect their employees and their customers and their potential customers when they reopen from the spread of the virus. And so that can be PPE for employees, protective shields and dividers, signage, graphics, technology, hardware, software for folks working at home, wellness scans, virtual meetings. It's a pretty broad list, but the idea was that we know that we can't meet a broad need. So the hope is that we can meet a need that can be fairly costly when businesses are reopening, and that has a public health benefit as well to meet that challenge. So I'm looking forward to announcing that. We're going to do $5 million and see how it goes. And if we need to do another kind of a program, we'll do another kind of a program. But we're very much open to ideas but the funds are limited. The areas that we're also focused on for funding are housing and food. So we do once a week sort of virtual town hall, we were calling it. And now we've changed it to Build Back Better, which is going to be our theme for rebuilding. And the first one was about hunger and food nutrition and the programs going on and the challenges that we face. There's one tonight that's on housing, particularly what's going to happen when the ban on evictions is lifted. So We have a eviction prevention program where the money goes directly to the landlord to pay the rent in some cases, and we're talking about expanding that program. So another experiment. We'll see how that works, and if it's effective, that will take up some of our money. So it's a constant stream of new initiatives and new ways to govern to meet a time that we didn't expect and needs that we didn't expect to be so severe. So that's my life right now, and working primarily from home, going into the office some, doing about 10 or 12 Zoom meetings a day, and finding that actually one can get a lot more done than when one is out shaking hands and giving speeches all day long. So it's not all bad from this end.
Thank you for those comments and the hard work that you're doing, and also the thoughtfulness and the creativeness to put together that new to be determined name of the program. But I think that's where we need to be. A lot of businesses are ready to go, and they know they're going to incur PPE costs, but they don't know what it is or how much. So a source of money for those businesses that are smaller would be greatly appreciated. So thank you for that. So okay, we're going to move forward here, and prior to bringing Anirban on, a couple things. One, we are recording this this program, so we'll have that available for a link if anyone wants to rewatch it.
I take back everything I said.
but it was all good. I wouldn't take it back. It was all very good. The other piece of the puzzle will be questions and answers. We have the Q&A function. It'll be along the bottom of your screen. So as Anirban goes through his presentation, if you have a question, just put it into the Q&A, and we're going to pick several of them on the back end and ask them to Anirban. Before we get started, like I said, we want to take a little temperature of our attendees here. We've got 238 folks on the line at this point. So let's see if we can bring up the results of the 2 poll questions. I haven't seen these yet either, so I'm going to be seeing these real time also. But let's get a sense, Amy, if you can pop those up, and let's see what our participants are thinking about the state of our economy. So real quick analysis here. It looks like when do you expect to return to pre-COVID-19 level of activities? The majority thinks it's going to be 6 to 12 months. Not the majority, but 43%. We've got, you can see the numbers, they kind of speak for themselves. I think folks are expecting this to be a kind of a cold start, if you will, and then have to ramp back up. So you can see what our participants today are thinking. And let's see, we go down to the second question. When we get to the new normal, how do you think your business is going to operate? We've got 35% saying they're going to stay at the same level. We see 31% seeing an increase, so that's a nice sign of optimism. We see a slight decrease for 31%, and then a significant decrease for 4%. So being a chamber guy, I look at that and say there's a good level of optimism out there. And I think with programs, as the county executive talked about, and all of us working together, supporting our local chambers, and trying to, all stick together, we're going to get to the other side, and we're going to be in the new normal, and we are going to make it work. But what will the new normal look like? And that is where I'm going to kind of transition to our speaker. Anirban Basu is a highly regarded economist. He's probably the leading expert on the economy of the state of Maryland, having served on various commissions under various governors. And so he's had the opportunity to study this particular economy very closely. So we're very fortunate to have him today. And with that, I'd like to present Anirban Basu to tell us what is going on with COVID-19 and the economy.
Right, brilliant. Thank you, Mark. It's a privilege to be with you, and obviously a privilege to be with county executive of a county that is one of Maryland's most populous, around 585,000 people in Anne Arundel County, last I checked. And so my job is to talk about the economy. And then, of course, I'm going to take some questions at the end of this. I've entitled the presentation today, Return of the Economist. certainly has been a return of the economist. I mean, when the economy was great, who needed economists? But I think we're, reasonably important at this point. This is a Lord of the Rings theme presentation. You'll see that theming throughout the presentation. So I think it's perfectly appropriate for me to begin the discussion with the ring verse, which says 3 rings for the elven kings under the sky, 7 for the dwarf lords in their halls of stone, 9 for mortal men doomed to die, 1 for the dark lord on his dark throne, in the land of Mordor where the shadows lie, 1 ring to rule them all, 1 ring to find them, 1 ring to bring them all, and in the darkness find them. You will see this organizational framework throughout my speech, my webinar. 9731, 9 rings for the kingdom of men and women, 7 for the dwarves, 3 for the elves, 1 for the dark lord. The Dark Lord has been pretty busy. This is a graphic of global cumulative confirmed cases as of May 11th. So it's May 12th today, but we are still very much in the midst of this crisis globally. You can see that. Now, the good news is here you can see some tapering off in terms of confirmed COVID-19 cases, but we're in the middle of it. And so when Anne Arundel County Chamber of Commerce stakeholders and other stakeholders on this Zoom conference call say, it's going to be 6 to 12 months, and some people, over 12 months. Well, that actually makes sense because that's where we are. Even as we're trying to open up various parts of the economy or the entire economy of Georgia, whatever it happens to be, very challenging. As of May 11th, nearly 80,000 deaths in America. So, I'm going to talk about the economy, but obviously I pay respect to all the people who have suffered and the families who have lost permanently here. So, but you can almost feel, even though this is a static map, the infection spreading into the American heartland. You can see the epicenters have been, and everyone knows this, New York and some of the other coastal cities, but Michigan, Southeast Michigan, for instance, and some other parts of the country. That's where we are, and so the economic effects of this are going to be lasting for quite some time. And I first I want to go through a bit of a stroll through memory lane. But when we talk about getting back to the way the economy was, and I thought that the survey responses were relatively upbeat in terms of a goodly fraction thought that they would return to normal reasonably quickly within 12 months, and many thought that if anything they might suffer a slight decrease in economic activity, and many others thought that they wouldn't suffer almost any. So let me talk about the way the economy was. That's the baseline, right, where we're trying to get back to. And if you're going to talk about the strength of this economic expansion that preceded COVID-19, I think you got to start with the job market. My goodness, wasn't it fantastic? We added jobs, this monthly job growth in America. We added jobs for 113 consecutive months in America, 113 consecutive months of job growth in America. Over that period, we added 22 million net new jobs. Now, I've indexed the data here on 2 different axes. Everything prior to March of 2020 is on the left-hand axis, but then in April, we lost 20.5 million jobs. So I had to change the axes. I had to add another axis on the right-hand side. Otherwise, all these other bars from other months would, become minuscule. But, that's what, but again, this is the good part of the presentation. This is the fun part. This is the way things were. So I don't want to get too negative at this point. I have lots of time for that. But, we have wiped out all the job gains, as people know, over the course of the expansion. We added 22 million jobs during the expansion. 33.5 million Americans have filed for unemployment insurance over the last 7 weeks, for which we have data. But boy, was it great. The data have yet to catch up to reality. So if you ask me the question, Anirban, according to the most recently available data, how many jobs did Maryland add between March of 2019 and March of 2020? And the guess would be, well, I mean, it's really not adding jobs. We lost a ton of jobs, right? No, the official data say 6,500 jobs. Now, why is that? That's because the reference week that the survey was undertaken by the Bureau of Statistics was early in March. And early in March was not a crisis-oriented period. For the most part, leisure hospitality, that restaurant and hotel sector started to feel some of the impact of restrictions and concerns about handshakes and physical proximity, so on and so forth. But it wasn't until March 9th, I would argue, that this crisis began from an American perspective. You say, Anirban, that's crazy talk. This is COVID-19. You know why they call it COVID-19? They call it COVID-19 because it was discovered in 2019. But it wasn't until March 9th that the stock market noticed. On March 19th, the Dow Jones falls more than 2,000 points. At that time, that was a record for a daily point decline on the Dow Jones Industrial Average. We then set records on March 12th and then again on March 16th. But it was a bad week. But until that time, the economy was actually functioning, and the markets were, not so volatile. It wasn't until March 11th, 2 months and a day ago, that the Utah Jazz were ushered away from the basketball court when their all-star center, Rudy Gobert, was diagnosed with COVID-19. Just a few days later, his fellow all-star, the Utah Jazz, on a terrific team, Donovan Mitchell, was also diagnosed. But that was, our lives have changed so much in 2 months. It's been 2 months. So again, when we get to the April data, they're going to look a lot worse for Maryland and everybody else. But the latest data right now for the states is March. And if you ask me the question, how many jobs have been added in the Washington metropolitan area over the last 12 months, which we have data, the 12 months ended March of 2020, I'd say, well, 0.9%. How about Baltimore, Anirban? And Anne Arundel County is part of the Baltimore metropolitan area for statistical purposes, 0.0%, no change. But again, that's because these data largely reflect the situation as of relatively early March. Obviously, the last 3 weeks of March were cataclysmic. GDP during the first quarter declines 4.8% on an annualized basis. And that was because of the last 3 weeks of March. I mean, January and February were actually quite good months for the economy. And, we enjoyed that 50-year low in unemployment at 3.5%. And I could ask Mark a quiz question. Mark, how long did it take for us to go to a 50-year low in unemployment? Answer: 50 years. It took us a long time to get to that point. That's how good it was. And so it could take us a long time to get back there. And no one should expect, as I go through this, that we're going to recover fully anytime soon. We'll talk more about that. Now, here I'm showing the 3 rates of unemployment: men in blue, women in green, total unemployment in red. During the previous economic downturn, the Great Recession, men were affected relatively more than women economically because men disproportionately work in sectors like manufacturing and construction. Construction lost 2.3 million jobs during that downturn. It was ravaged, and as a result, male unemployment rises faster. That was one of the reasons. This time, actually, women have been hit harder economically. If you look at the green line, that green line goes way up. The official unemployment rate for April nationally was 14.7%, but it was meaningfully higher for women because women are more likely to work at daycare centers, schools. They're more likely to work in retail, hospitality, so on and so forth. Also, many women have been on the front lines of delivering care. Easy majority of American nurses are women. So this time around, actually, women are being hit harder. As it turns out, but both genders hit hard during the Great Recession and currently. And, that 14.7% number is misleading. But a lot of the data right now are misleading because there was a glitch with the survey that the Bureau of Labor Statistics conducted as they're getting, getting data for April. And if you look carefully at that release, you'll see that because of that glitch, the unemployment rate was probably underestimated by around 5 percentage points. So the real unemployment rate for April was probably closer to 20%. And, my best estimate that right now we've crept past that 20% threshold in the US. This unemployment rates, again, that stroll through memory lane, that kind of leave it to beaver moment, the way the economy was. And as of March 2020, the unemployment rate in the Washington metro area was 3.3%, in Baltimore metro 3.5%. Again, I know we have a lot of CEOs, a lot of business owners in the audience, and you probably say, I want the latest data. No, you don't. You really don't want to see April. You don't want to see May. It's going to be awful. I'll show you some of those days to go through it, but it's really going to be, it's going to be what it's going to be. And we'll talk more about where this economy is headed. Again, through March 2020, Anne Arundel County's unemployment rate is 2.9%. What was the challenge pre-crisis? The challenge was finding enough good workers, wasn't it? That's what we complained about. That was our biggest complaint. Can't find enough human capital, enough reliable workers. If you're going to have a problem, that's the one to have. That's what I used to tell people. The problems we have today are much worse. When 1 in 5 Marylanders is filed for unemployment insurance, that's a bigger problem. And, well, again, we're going to talk more about where the economy is right now, but also where it's headed. But this is the baseline. This is where we want to get back to. I mean, graph Anne Arundel County unemployment over time, again, you see that 2.9% figure for March of 2020. It's not that anymore. You know that. I know that. If you think about major segments of the economy like restaurants, BWI, and we're approaching the summer months now, and that's a really active period in Annapolis and along the waterfront and other parts of Anne Arundel County. So, if the national rate of unemployment, if I'm right about that, in April is really around 20%, then Anne Arundel County is, given the structure of its economy, the fact that there's some stable institutional anchors, whether the National Security Agency or the Naval Academy, so on and so forth, it probably is not going to be 20%. It's going to be something less than that, but it's going to be quite elevated. Again, pre-crisis, with that low rate of unemployment, with the economy supporting more job openings than unemployed people, as it turned out, we had more than one job opening for every unemployed person in America for a time. So guess what happens when you've got so many people, so many employers chasing human capital? You get faster growth in wages and salaries. So what have we said so far? I mean, this is as measured by the U.S. Employment Cost Index. So what do we have so far? More people working, more people earning money on the job, good money on the job. I mean, Amazon raises minimum wage to $15 an hour, not for charitable purposes, the for-profit enterprise. But that's what it took to try to retain workers at the fulfillment centers. I mean, if you're trying to move towards same-day delivery, you can't be losing your best workers at the fulfillment centers. Bank of America, $20 an hour minimum wage. It's a reflection of how strong this labor market was. And so more people working, more people earning more money on the job, they're putting stuff in the bag as they're shopping. And as you know, about 68 to 70% of America's economy is consumer spending. Well, the consumer was empowered to spend. Now, if you look carefully at this chart, you can see that retail sales fall off the table in March. We start to see the damage from COVID-19. We've seen bankruptcies now from J. Crew and Neiman Marcus. You're going to see a lot more. Oddly enough, the number of bankruptcies right now is probably stifled a bit by the fact that the economy is shut down. So, Anirban, why is that? Because when one declares bankruptcy as a retailer, one of the things one wants to do is liquidate inventory. It's a source of cash flow to liquidate that inventory. It helps pay legal bills and other bills. But if I can't open my stores, I can't liquidate inventory. So oddly enough, you might see an even faster rate of retail bankruptcy once the economy opens up in earnest. And coming out of this period, the prediction would be, I think, you can disagree, obviously, maybe you do, but lots of empty storefronts, lots of mall vacancies, lots of empty office suites. And commercial real estate will be one of the final segments of the economy, I think, to really recover. We'll talk more about that. But the other part of the miracle was this is, look, I've been taught, you have been taught that when unemployment falls in a society, inflation goes up. It's the Phillips curve. So we had a 50-year low in unemployment. So what would you expect? Well, significant inflation. Didn't happen for years. And this is inflation as measured by the core CPI, the core consumer price index. Inflation has run between 1.5% and 2.5%. Well, that's brilliant, isn't it? Because the Federal Reserve's target is 2%. We've been right there. In fact, inflation has been such a non-issue for our society that last year, even as we were marching toward that 50-year low in unemployment, the Federal Reserve cuts rates 3 times. Not once, not twice, but thrice. The so-called mid-cycle adjustment, as it turned out to be a late cycle adjustment. But the point is, low unemployment, low inflation. That's what you want. That's what you dream about in a macro economy, and that's exactly what we have, and that's what we obviously want to get back to. When inflation is low, interest rates tend to be low. Now, don't get me wrong. The economists make this mistake of talking about low interest rates as purely benign. But they're not. I mean, if you're a retiree or trying to save for retirement or managing an underfunded pension fund or any pension fund or, head of a life insurance company or the investment manager thereof, it's more difficult to generate income when interest rates are so low. So there's that. But if you're trying to perpetuate a growth cycle, if you're trying to help people refinance, purchase automobiles, homes, other big ticket items, low interest rates pretty helpful. And interest rates have been hobbit-sized throughout this. So we had our cake and ate it too, didn't we? Because we had low unemployment and low inflation and low interest rates. And those things often don't go hand in hand. Really, quite terrific. And so one of the implications of that is rise in property values, including in Anne Arundel County. You talk to realtors, at least pre-crisis, what do they tell you? Look, I got lots of buyers out there. I got lots of folks looking at homes to purchase, whether it's Severna Park or Glen Burnie or other parts of phenomenal Anne Arundel County. I got a lot. The problem is I don't have inventory to show them. The inventory of unsold homes is low. The first-time buyers coming back. Some of the baby boomers looking to downsize. Everyone's got their different needs, but people are ready to transact. I just don't have enough product for them. So when you've got strong demand coming out of a good economy and weak supply, guess what happens? Property values rise. This is the U.S. National Home Price Index, and you can see, the progress we've made. So now what do we have so far? More people working, more people earning more money at the job, home values rising, more builders filing for residential building permits or applying for them. You see the surge in residential building permits late last year into 2020. A lot of that growth was because of single family permitting. Because, 5 years ago, the most common age in America was 23. So when you got a lot of 23-year-olds turning into 24-year-olds and then 25-year-olds, guess what you get? A lot of people renting apartments. And we had that apartment building boom. But 5 years later, the most common age in America is 28. Second most common age in America is 29. Third most common age in America is 27. And some of the millennials are now in their 30s. So they're forming households, they're getting married. Some are even having kids. Still not a lot because the US fertility rate at 1.73 is at a record low as it turns out, but it's going to happen eventually. People think about good school districts and so on and so forth, safe homes, safe neighborhoods. Anne Arundel County offers that. So, and so guess what was happening? Home builders enjoyed a level of confidence that they had not seen for 20 years. More were, applying for permits. Why? Because demand is high, supply is low. There's an opportunity for them to meet unmet demand. And then there's the stock market. My goodness, wasn't that fantastic? You remember that joke we all used to say during the Great Recession? Remember that joke? My 401k is not a 201k. You remember that? By the way, no one ever laughed at that joke. But then your 201k became an 801k. And that was fun. Not funny, but fun. So I've indexed the Dow Jones to your right here and the NASDAQ and the S&P to your left. The closing bell is about to ring in 21 minutes and 52 seconds. The market seems like it's down a bit today, but the NASDAQ, if it falls today, it'll be the first day in 7 days that it'll fall. I mean, the markets have held up pretty well. The Dow is sitting at almost 24,000 as I'm speaking to you, but it was, so more people working, more people making money on the job, their home values are rising, assuming they own a home, of course, and then their portfolio is rising as well. I entitled this slide, but it goes to Elven, which of course is a way for me to acknowledge the fact that in Lord of the Rings, there are a lot of elves, but also to fully understand the title of this slide, one would have to harken back to a movie that came out in 1984 called This is Spinal Tap. And if you know what I'm talking about, that reference, this becomes hilarious. But even setting that aside, that's where we were. But even as that economy was expanding, and now I've done the 9, I'm about to do the 7, even as the economy was expanding, some vulnerabilities were emerging. Number one, not all segments of the economy were fully participating. So we could talk about agriculture, single-family home construction for much of the cycle. Now that was about to turn around pre-COVID-19, but we didn't quite get there. And manufacturing. So this is the Institute of Supply Management's Purchasing Managers Index. Any reading below 50 means that US manufacturing is in recession. And yes, the index is below 50 in 2001. Well, the broader economy was in recession in 2001. Index is negative in 08, 09. Well, yes, the broader economy was in recession in 08, 09. Actually, that recession began in 2007, December. And then for 5 months late last year, manufacturing is in recession. Trade war with China, strong US dollar, which among other things frustrates export growth, the issues at Boeing, the fact that the US auto sector had peaked in terms of activity roughly in 2016, and was having to compete with a lot of cars coming off of lease. And then late last year, what happens? We get that first phase trade with China, we get ratification of the USMCA, the US-Mexico-Canada trade agreement. We see Boris Johnson's resounding victory in the United Kingdom, which gave us more certitude regarding Brexit. When was the last time you talked about Brexit? You couldn't stop talking about it for 3+ years. Well, you might have been talking about Boris Johnson lately, but not Brexit. So all of a sudden, a lot of that uncertainty supplying the global supply chain abated, and U.S. manufacturing responded. The reading comes above 50, it's out of recession. But then by February, because of the global supply chain interruptions, including those emerging from China, because the issues at Boeing are still there, because the global economy is slowing down, manufacturing now back deeply in recession. But the greatest source of vulnerability relates to this, indebtedness. And indeed, from a structural perspective, this is Anne Arundel County's greatest source of vulnerability long-term. So too much data on here by half, but this comes from the Nonpartisan Congressional Budget Office. So as of March of 2020, there was baseline estimate for the federal budget deficit for 2020 and 2021. And the baseline estimate was that in both 2020 and 2021, the federal budget deficit would be around $1 trillion. Now we have updated forecasts from the Congressional Budget Office. The new estimate for 2020, federal fiscal year 2020, is $3.7 trillion. I say billion, I meant trillion. $3.7 trillion. And for fiscal year 2021, $2.1 trillion. And we came into the crisis with a $23.5 trillion national debt, which makes response awkward, right? Because one of the concerns right now is, are we putting too much money out there? I mean, there's a plan coming from Congress today. I won't tell you which party put it forth. I want to be nonpartisan, but $1 trillion for state and local governments as a starting point. I mean, I'm not saying that's a good idea or a bad idea, but one of the sources of awkwardness there is that, well, do we have all that money? What does this mean? Are we going to have a debt crisis at some point in the future? What does this mean for inflation and interest rates? We'll have a chance to talk more about that in a moment. But you could argue that America's been growing for a lot of the wrong reasons. Let's do some simple math here, shall we? So last year, the US economy grows 2.3% in real terms, meaning inflation-adjusted terms. I didn't mention it, but there's another measure of inflation actually favored by the Federal Reserve called the core PCE deflator, or core personal consumption expenditures deflator. And that measure of inflation suggests inflation is running around 1.6, 1.7% over the past year. So if you add those two numbers together, that 2.3% plus the 1.7%, you get 4%. So in nominal terms, last year, the US economy grows 4%. Let's do some more math. The federal budget deficit last year, meaning the calendar year 2019, was $1.02 trillion. We, the American people, produced $21.7 trillion in economic output last year, which means that the federal budget deficit as a fraction of GDP in 2019 was 4.6%. You take away that 4.6% deficit spending, there is no economic growth in America, at least statistically speaking. And even before the crisis, the dark blue lines or bars here represent forecasts from the Congressional Budget Office. Even before this crisis, the Congressional Budget Office was forecasting massive deficits as far as the eye could see, 4.8% of GDP year after year after year. Right? Or around that, the average for the next decade. Now it's going to be much worse as a result of this. We have massive, we just got numbers today about the budget deficit for April itself. Just for the month, it was over $700 billion for the month. And one of the reasons for that is that they postponed tax payments, right? So that's part of it. So income that normally would have come into the federal government didn't. But for a county like Anne Arundel County, which is so wedded to the federal sector, whether agency employment or federal government contract employment, whether defense or civilian contractors, this is a structural issue. And one of the goals for Anne Arundel County, the businesses, the chambers of commerce, obviously local government, has to be to begin really aggressively diversifying that economy. I'm not saying that's not already happening. I'm just saying that's a need, because one of these days, this federal government is going to have to deal with this deficit demons. And I don't know when it is. Is it 2026 when Medicare goes insolvent? When is it? I don't know. But it's coming one of these days. But of course, the federal government is hardly the only one to have taken on lots of debt. This is household debt. Graph back to 2003. Here I'm showing you various flavors of consumer debt. Orange is mortgages, blue credit cards, red student loans. My goodness, look at the red bar here, the segment. That's how much student lending has increased. You know, people live paycheck to paycheck. And one of the reasons for that is because they've taken on a lot of debt in many cases. Not everybody, but a lot of folks. And cumulatively, you can see where we've come since, let's say, 2012, 2013. When there was that period of deleverage of the household balance sheet for a time. That ended many years ago. In nominal terms, household debt has never been greater. In nominal terms, corporate debt has never been greater. You say, Anirban, how can that be? You just talked about a booming stock market. Undoubtedly, corporate earnings have been strong, you know, to serve as the foundation for that booming stock market. So, and we passed corporate tax cuts in late 2017. So haven't corporations in America been, on average, paying down their debt? No. This is what happens when you buy back your shares every year. I'm exaggerating a little bit. But you issue debt to buy back the shares, debt goes up, equity goes down. You know, this also is what happens when you buy back your leading buy your leading competitor. Right. The peak year for mergers and acquisitions during the cycle was 2018. The peak year for mergers and acquisition activity was 2017. The peak year for stock buybacks in the cycle was 2018. But every year we've seen a lot of this. So within days of the crisis, what did you hear? Boeing raise its hand and say, "We need $60 billion, government." They only have one competitor, but you know, one of the reasons was they had a lot of debt coming into the crisis. And obviously they had the issue with the 737 MAX. Productivity. Let me talk about this for a little bit, because ultimately it is productivity growth, sorry about that. It is productivity growth that determines how rapidly our living standards will increase from year to year to year. I mean, growing up, what did I hear? I grew up in Kankakee County, Illinois. What did I hear? You know, people say, Anirban, the average rate of growth in America in real terms is 3% per year. Sometimes it'll be faster than that, sometimes slower than that. Sometimes Jimmy Carter is president, sometimes Ronald Reagan is president, sometimes it's Bill Clinton, but 3% a year on average. If you ask an economist like myself, how much will America grow on average going forward? I mean, post COVID-19, how much? 2% will say. Why? Well, I mean, look at the third bullet here. U.S. productivity has risen at an average rate of 1.3% since 2007, compared with the 2.1% average since the end of World War II. Productivity is measured as output per hour worked. Growth ultimately is labor force productivity growth plus labor force growth. That's it. And whether because of immigration or the retirement of baby boomers, the labor force is not growing the way it used to, and productivity is not growing the way it used to. So 2%, and maybe that's optimistic. And just because we're focused right now on COVID-19, this global pandemic, doesn't mean that other issues are still not out there, including the fact that there's still a North Korea out there, there's still a Middle East, there's still a France. That's a joke. So this is the Global Economic Policy Uncertainty Index. And uncertainty globally is high right now because many nations are pursuing their own path. Global supply chains are fragmenting. All kinds of talks about retaliation against one particular society. Now, late last year, that was not the case. Late last year, global uncertainty was actually declining because we got that first phase trade deal with China. So global trade disputes were beginning to cool just a bit. And we got ratification of the USMCA, the new NAFTA. And we had Boris Johnson's resounding victory in the United Kingdom. I'm not saying I love Boris Johnson or don't, but his victory helped assuage or allay some of that uncertainty. So this is another factor to think about. What is the world economy going to look like? What are global trade patterns going to look like once COVID-19 is over? What are we left with? And then the final source of vulnerability relates to this. Asset prices were really high coming into this period. Here I'm graphing for you the Shiller price earnings ratio. So what I'm trying to do here is I'm trying to juxtapose the price of shares on the S&P 500 vis-a-vis the underlying earnings of those corporations. And now you can see from the chart that recently the price earnings have compressed a bit as the market has declined. But prior to the crisis, you would have had to go back effectively to March of 2000, just before the dot-com bust, to see a market so priced to perfection. So what goes up can come down. What goes up a lot can come down a lot. And we had a market. Now, don't get me wrong. We came off a brilliant decade. I mean, some of this is justified. Some of this rise in share price is justified. I mean, something very unusual happened in the previous decade. In previous decades, America's share of global output declined. And some of that was engineered by the Americans, by the way. It was the Americans who fashioned the Marshall Plan to help rebuild Europe after World War II. It was the Americans who spent their own treasure to help accelerate the recovery of the Japanese economy post-World War II. In an effort to try to transform our sworn enemies into our future trading partners. And boy, did it work. Germany is today the fourth largest economy in the world. Japan is third. But something interesting happened during the previous decade. America's share of global output actually rose from 23% at the beginning of the decade to 25% by decade's end. And look, we have lots of issues as Americans, our infrastructure, our broken politics, our national debt. But we're less than 5% of the world's population, and yet we're a quarter of its output. We're doing something right. We're doing something right. But does this performance, as remarkable as it is, justify this performance? This is stock market returns by country or region or society from 2010 to 2019. Look at America, 256% return in a decade on stocks. Now think about that. Take 256%, divide by 10, the number of years in a decade. Now you get a back of the envelope calculation of rate of return per year. Oh, it's massive. Yeah, your 201k went into, you gave me 81k. Emerging markets are 49%, India 46%. India grows 6% during a bad economic year, I mean pre-COVID-19, in real terms. So this sorts of vulnerability. And oddly enough, I mean, I think, and naively, there were some economists who would have said to you, look, our economy is so strong right now, we have so much momentum, we can get through this COVID-19 issue without a recession. Can you believe that? No, no way. That fundamentally misunderstood the nature of this issue because COVID-19 is just different economically. I've done the 9, I've done the 7, let me do the 3. Number one, this is a supply shock. This is not a demand shock like 2008, 2009. What was the situation then? Credit tightened up. Subprime mortgage crisis, all that. Credit tightened up. Banks became insolvent. Money was not available. So what did we do? We pumped money back into the economy. We put air back in the balloon. And that triggered the lengthiest economic expansion in American history. Though it also caused people to take on a lot of debt. But this is supply shock. Quarantines, travel bans, closure of public places. Can't see the Baltimore Orioles. And those containment measures lead to factory closures, supply chain disruptions. We can't go to work, a lot of us. About 30 to 33% of us can work remotely. We're the lucky ones. And that supply shock then leads to a demand shock as people lose their jobs. As 33.5 million Americans file for unemployment insurance over a recent 7-week period. As 1 in 5 Marylanders finds themselves on unemployment insurance or having filed for unemployment insurance. And that produces loss of income, loss of confidence, so on and so forth. But ultimately, that irresistible force that was the economy pre-COVID-19 hit an unmovable object, which is COVID-19, and the unmovable object or immovable object, it won. And so economists are coming to terms with the fact that this quarter, the current quarter, the second quarter of 2020 is unlike anything that's been experienced in America before in terms of pace of economic decline. Economists at Morgan Stanley predict a 38% decline in GDP for the second quarter. JP Morgan Chase economists 40%. By comparison to the worst quarter of the Great Recession in late 2008, the economy shrank 8.4% on an annualized basis. This is just different. I know that there are temptations to try to compare this to the Great Recession. I was on a panel discussion with economists late last week, who compared this to Katrina in New Orleans. I mean, it defies comparison, please. Obviously, some segments of the economy are more vulnerable than others. If you look at the second bolded row here, employed in occupations at high risk of layoff, according to the Federal Reserve Bank of St. Louis, which conducted the study that created these data, 67 million Americans at high risk of layoff. That's 46% of total employment. That includes folks in food preparation, so that's your restaurant workers, sales, that's your retail workers, production occupations, that's your manufacturers, among others. So, I mean, so if I say to you that unemployment in America could reach 25 to 30%, that's realistic. And it's probably already above 20%. Because so much of the data have been lagged, I showed you the March unemployment for Maryland, but so much of the data are not yet current. We've been looking for high frequency types of data. Here's one. This is initial unemployment insurance claims for unemployment. So for the week ending May 2nd, we had 3.2 million Americans file for unemployment insurance. Good news, it's less than the previous week. Bad news, 33.5 million Americans have filed over the last 7 weeks for which we have data. Now, it is conceivable that somebody could lose a job today, file for unemployment, and then get a job tomorrow. I'm not saying it happens a lot, but it could happen. So the more important measure might be continuing claim for unemployment insurance. Now, unfortunately, the latest week for which we have these data is for the week ending April 25th. And by that point, you can see the graphic here, what's happened since the crisis. But 23 million Americans, not quite 23 million Americans, we're on unemployment insurance. So I mean, if you do the back of the envelope calculation here, you easily get to 20. I mean, you can be unemployed and not be on unemployment insurance. So there's that. But what we want to understand, I think, is we know the economy is bad. I mean, I haven't told you anything you don't know. I think what you'd like to know is or hear about is is the recovery going to be L-shaped, or Nike swoosh, or square root, or check mark, or U, or V, or W? Well, for now, I can tell you I think it's going to be a V. And I think your survey responses were consistent with that. A lot of you thought that we're going to get back to it within 6 months. So this comes from Oxford Economics, and too many lines on here by half, and I'm trying to race for the Q&A. But so let me walk through this a little bit, though. The blue line there, okay, what's that? This comes from Oxford Economics, and I have enormous respect for the folks at Oxford Economics and the way they forecast the economy, globally and at the national level. So that blue line relates to their forecast pre-crisis, the January baseline. Okay, so you can see what, it's indexed here, but you can see that they were expecting the global economy to continue to grow steadily. Now the yellow line represents the current forecast baseline and basically says this crisis lasts globally for effectively 2 quarters. Over that 2-quarter period, the economy shrinks globally 7%. The red line says, oh, wait a second, we don't know that it's just going to be a 2-quarter event. Maybe it's 3 quarters. And if it's a 3-quarter event, the economy will shrink globally 13%. That's the red line. But look at this yellow line and this red line carefully. If you peer at that long enough, what do you see? You see the letter V, V for victory. That's the way the initial phase of this recovery is going to be. I'm not talking about complete recovery. No, that's going to take years. But the initial stages of recovery will be very forceful. And I'm not just saying that because Oxford Economics says so. That's the way it has been when we've observed previous pandemics. So this analysis comes from Goldman Sachs. Too much data on here by half on this graphical element. But if you could just fix it on the blue line there, the blue line that goes way up and then back down again, that characterizes economic activity in Hong Kong during the SARS outbreak of 2003. The skinny 0% line, that black line there, that's the average rate of pre-existing growth. So pre-crisis, the average growth rate for these societies. Now, during the early phases of the crisis, what happens? The public health crisis, growth falls below average. Of course it does. Of course it does. But if you follow that blue line, and things then get worse thereafter as more and more segments of the economy are impacted. But then what happens? The economy shoots up. It's a V. You see a lot of V's on this chart. Now, measured in the form of weeks, it's not going to be a very pointy V because we're going to open up the economy gradually. But if you look at this from the perspective of months and certainly quarters, it's going to be a V. And this, again, is consistent with your collective survey responses. I'm so glad that Mark did that. And one of the other reasons I think it's going to be a V is there's just so much stimulus in the pipeline. We've already had 4 rounds of stimulus. We're going to have a 5th. But there's going to be a state local governments. There better be. Because we've seen so many private sector workers lose their jobs, but now public sector workers in Detroit, Los Angeles, elsewhere, Maryland, have begun to lose their jobs, be furloughed, or even laid off. We don't want that because that would exacerbate the situation. So the biggest round of stimulus was phase 3, the CARES Act, that more than $2 trillion package. But we pumped a lot of money into this economy, and as Secretary or Treasury Secretary Steve Mnuchin pointed out earlier this week, a lot of the money that's associated with these 4 phases of expansion or stimulus are not yet into the economy. People are still waiting for their checks, still waiting for their loans, so on and so forth. So we are addressing the demand part of this. And of course, the cure ultimately comes not from the federal government, the Federal Reserve, it comes from Regeneron, Gilead Sciences, Pfizer, Merck, Sanofi-Aventis, somebody, Bayer AG, somebody in the life science community that finds a therapy beyond remdesivir, which is a Gilead Sciences product that's been shown to have some efficacy, and then a vaccine, of course. That's what we need. That's what gets you out of the supply shock part of this. You can manage demand for a time, but you need the supply shock to be unwound. And when it unwinds, boy, watch out, this economy is going to shoot higher. So that brings me to my final slide, the one forecast. Look, I'll say it very obviously, the recession has already begun globally and in the United States. I've known that for a couple of months now. But I still expect this episode to be short and vicious. That's how my wife characterizes me. And it's a 2 or 3 quarter event. Now, I can't tell you for sure whether or not we get out of this in July or August or September. My older daughter goes to college in Philadelphia, and all her friends are canceling their leases that begin July 1st because they're expecting the University of Pennsylvania is going to open up, with remote instruction, so they don't have to move into their apartments. Yeah, who knows? The best positioned people work in the public sector. They enjoy greater job stability. The private sector workforce is being absolutely hammered. Unemployment has reached officially 14.7%, but don't believe it. It's already 20%. Glitch in that survey. Our collective expectations as the economy is still adjusting to the downside because we're trying to understand, do we have a resurgence of this in the fall and into the winter when, more people are coughing, more people are sneezing, and humidity goes down? Because higher humidity is not good for this virus. It's one of the reasons we expect things to get a bit better in the summer. But I'll tell you this, when it commences, recovery from this crisis will be sharp, profound, and most welcome. Look, people, when they get back to work, will be finding what? Interest rates will be low, pent-up demand high. There'll be a need to rebuild inventories because General Motors, Ford, Chrysler, BMW, others have shuttered their plants. I'm noticing now the Dow Jones, as I'm speaking, is falling, down 457 points. Sorry about that. People are anxious to meet again, go to restaurants, including on Anne Arundel County's phenomenal waterfront and in, spectacular Annapolis, elsewhere. See a movie, watch the Orioles, which is the most fabulous thing a human being can do on this planet other than nurturing a child, and then engage in other most wonderful of human activities. So watch for that. It's been a V from previous episodes. It'll be a V this time. Complete recovery will elude us for years, but Mark, I give it back to you. Thanks a lot.
That is great, Anirban. Thank you for that overview and kind of taking us back to a sense of reality, kind of tore down history lane and then kind of getting a sense of where we're going to move forward. We've had some good questions come over to us. Let me go with one right here. And it kind of focuses in on the recovery and regionalism and the fact that as companies do start to come back and Maryland has the higher corporate tax rate, what do you think the impact might be if other companies could move to Virginia, Pennsylvania, Delaware, and they're still, retaining their employees?
Mark, they've been doing it for years. Maryland is considered the Connecticut of the Mid-Atlantic. We've got that high above 8% corporate tax rate. Virginia is sitting at, last I checked, 6%. A governor there who happens to be Democrat, says it's too high, it should be 5%. I would tend to agree. And what's going to get us out of this, Mark? What's going to get us out of this is entrepreneurship. Because we're going to emerge from this period with a lot of empty storefronts and a lot of vacant office suites. So a lot of business owners right now are going to say, I quit, I'm done. Now, some of them will come back. I think actually more will come back than people expect, because when those business owners who have already said we're not opening back up, look around and say, what am I going to do with my life if I don't open up? Some of them are actually going to come back, even though they're telling us right now they're not. But many won't, they can't. Finance is too badly bruised, confidence too badly injured. And so what do you need? You need another generation, another group of entrepreneurs to come forward. Now, many small businesses, of course, are subchapter S corporations, LLCs. They're not subject to the corporate tax, but their clients often, let's say architectural firms or legal firms, their clients are often C corporations. And that's where our very high corporate tax rate really hurts us. And here's the frustrating aspect about this, Mark. I really believe that our high corporate tax rate in our state actually generates less income for Annapolis than a lower tax rate would. That if we could broaden the corporate tax base, and we just lost the headquarters of Legg Mason and William Scotsman in Baltimore, if we could broaden the tax base with a lower corporate tax rate, we'd actually end up collecting more in corporate tax revenues, which as it is, only represents about 4 to 5% of total general fund revenues for Annapolis anyway. You could get rid of the corporate tax altogether, and you wouldn't make that much difference on Maryland's budget. But the corporate tax rate as it is, not only doesn't make much impact on the budget, it makes an enormous impact on the economy because people choose to locate their headquarters elsewhere, whether Amazon or others. So, deeply frustrating. That's a chamber issue, and it's another thing to talk about when Annapolis reopens for legislative business.
Okay, great. Thank you for that. Another question, someone was focusing in on industries, the commercial real estate and retail you spoke about. Could you talk a little bit about some of the other industries that might be most impacted by as we start to move to a reopening?
Right, some industries will be positively affected, right? So I would expect that medical centers, inpatient medical centers, hospitals will be positively affected because there's been a realization here that we strip too much cost out of our hospitals. Since the 1970s, the game in Maryland and the game elsewhere has been stripping costs out of inpatient medical centers. And that includes putting things into outpatient settings. So we have now outpatient surgical centers. You have your surgery not in the hospital, but an outpatient center. And then you walk home, I guess. And that's fine for many surgeries, but it's a tail wagging the dog. The goal has been to minimize costs and not necessarily improve the quality of the experience of the patient, not always. So now, we've found that these hospitals don't have enough capacity. They don't have enough ICU beds, don't have enough ventilators. A lot of the physical plan has been beaten up because, that physical plan has been overutilized for quite some time now. So we're going to have to recapitalize our hospitals. So you're going to see that as an industry. Second, e-commerce. How many of us are now ordering routinely on Grubhub or DoorDash? Grubhub, the stock is way up today because there's a rumor that Uber is going to buy Grubhub. And so data centers, right? Because when the e-commerce economy takes off, it got a real jolt, a real shove in the back forward here. That means more need for more repositories of data. So data centers, another one. Heating, ventilation, and air conditioning. So what about heating, ventilation, and air conditioning? Why, Anirban? Because that's a way to mitigate contagion of things like COVID-19 through air handling systems. So you're going to see a lot of upgrading of those systems in Class B buildings, Class A buildings, so on and so forth, because tenants of those buildings are going to demand that, or they're going to look for that when they sign their next lease. Manufacturing, and this matters, I think, for Anne Arundel County. Manufacturing is going to be a winner because you're going to see a lot of reshoring of production from East Asia, China in particular, back to the United States. That was already happening, Mark. That was a pre-existing trend because of intellectual property issues and the fact that Chinese workers are not as affordable as they once were, all those kinds of things, and shipping costs, all the rest of it. But also interruptions repeatedly to the global supply chain. Well, this has been an interruption to the global supply chain. So, you're going and one of the aspects of this is the North American Free Trade Agreement, its update via the USMCA. It's a great deal for North America. It really induces global CEOs to put more of their production in North America if they want that favorable tariff treatment and better access to the American market, which is the largest economy in the world, Canada, which is the 10th largest economy in the world, Mexico, which is 16th. Commercial real estate stands to be one of the sectors most negatively affected. Movie theaters, very negatively affected, because one of the things that people have done during this crisis is what? They have their Netflix if they didn't have it before. They have their Amazon Prime. They have their Disney Plus. And a big screen television, 85 inches or 80 inches or whatever it's going to be, it doesn't cost that much anymore. You can buy a really big television for $500. So what do I need to go to a movie theater for? And then finally gymnasiums. Because so many people have been buying Peloton bikes or other exercise equipment for their homes. So all of a sudden, that's their gymnasium, and a lot of people probably don't make good use of their gym membership to begin with, right? You get it. You're really all there. The first 2 months, Mark, you know what I'm talking about. You're there all the time, but I haven't seen you for a year. So anyway, answers to your question.
Let me give you this last question. I'm going to kind of combine two here, and it factors in again on the industries and the government regulations that might focus on 50% utilization. How would that impact restaurants, the Ravens, casinos? You mentioned hotel or movie theaters, and how will that work? And with all of that, impact on the mall. Everyone goes to the mall, and how will we be looking at that in the do malls? Will they be different in the future?
Yeah, I would think so, but not forever. And here I take some solace from the previous economic downturn. I mean, you might remember during the previous economic downturn, Mark, there was this notion that, households took on too much debt. We had the subprime mortgage crisis, with the foreclosure crisis. And so people are not going to take on debt the way they once did. You remember all that talk? They're going to deleverage. Yeah, that lasted for 3 or 4 years. But after that, what happened? We went right back to it. Because what does everyone want? Everyone wants a Jeep Cherokee and a 3-bedroom, 2.5-bath house. That's what we want. And often we need debt to finance it. Okay, fine. With this, what do we want? We want a handshake. We want to go to the mall and hang out, whether it's House and Town Center or whatever it has to be. That's where my daughters go. That's what we want to do. And we want to see the Orioles play. And they're about to draft they have a second pick in the draft this year. So we want to see this guy's going to be great. So we're going to get back to it. And what do we need? We need a vaccine. One vaccine, and we're back to life as normal. One vaccine. And we've got over 100 clinical trials happening out there around the world. And we've got heavy hitters engaged with these clinical trials. Somebody's going to figure this out. And we're going to get back to now. So we can fixate on the short term, just sort of gradually opening up of the economy. And, you've seen perhaps pictures of what's going on with the Disney park in Shanghai and the social distancing there and so on. But people want to get back to it. And at some point, those social distancing mechanisms are going to go away. We're getting back to normal. So I would rather focus on the longer term when we get back to normalcy, in the short term when we take these baby steps back to opening the economy. So this summer is shot for Ocean City, so on and so forth. We know that. It's awful. But next summer, I think it's going to be very different.
Okay, well, thank you. I know we went a little bit over, but we covered a lot of ground. Clearly, there's more than a lot of interest in everybody to understand, where the economy is going, and in the state of Maryland and in Anne Arundel County. And you do a great job of drilling down with the data and giving us that focus. And with the Lord of the Rings giving us the kind of the guidance here, I think we've got a good takeaway here. So again, our thanks from the Anne Arundel Chamber and all the other chambers that participated, and our sponsors. Thank you. And again, folks, this we'll have the presentation as a link for you to look at, and I guess we'll have the slides also. So again, thanks. Stay safe, keep the faith, and we'll be moving forward to a strong economy in the future, and maybe we'll see each other at a Ravens, definitely an Orioles game. They'll have a lot of openings there. So anyway, thanks again.
Easy to social distance at an Orioles game.
They've been practicing it for a couple of years, so good for them. But they'll be back, no worries. So, all right, thank you, everyone. Stay safe, and we will be in touch. Take care.